Hello friends, a very warm welcome to my channel. Today's video we are going to analyze a microcap company. So few things which you should know about microcaps is microcap investing is highly risky. Somebody who is able to spend time in the research, who's able to closely monitor the scripts, and also who has in-depth knowledge of fundamental analysis should only invest in microcaps. You should keep your position sizes small as there can be high volatility in the microcap space. And another thing you should remember that whenever we do a stock analysis, it's only an analysis and it's not a recommendation from my side. I bring forward all the positive, negatives of a particular company in an unbiased manner for you to take a wise decision to invest or not in a company. So that the company which we have picked up today, in fact, it is picked up by you from the Telegram channel, is Ajooni Biotech. So if you're new to the channel, please do subscribe and hit the bell icon. And if you're not a part of our Telegram channel yet, do join there as we can stay connected on a daily basis, discuss daily market analysis and lots of interesting stuff there. So Ajooni Biotech is a company which manufactures cattle feed and feed supplements. So it works in an industry which has huge scope, especially in a country like India, which has one of the largest livestock populations in the world. They are into the manufacturing and sale of animal feed and supplements, and this company got recently listed in 2017 in the NSE Emerge platform, and in 2021 they migrated to the main board. Presently the capacity for their animal feed is 60,000 metric tons per annum, and they are further expanding their capacity, which we'll discuss going forward. And in the supplements they have 30 lakh liters per year capacity. They have 3 manufacturing units, including the one which they have newly started, and they have an exclusive tie-up with IFFCO Kisan, which is a company of the similar industry, which brings a lot of synergies in their business. At present, the company mainly operates in the North Indian region, but still has presence in across 8 states. So talking about the management of the company, Mr. Jasjot Singh is the chairman and managing director of the company. There are other family members also managing the company with him. He has 12 years of experience in the pharmaceutical and healthcare businesses and the veterinary space. He has done his MBA from Oxford University, UK, and he has also won certain awards in the entrepreneurship space. Now let's move on to the business analysis of the company. Broadly, we can divide their business into 2 segments, which is cattle feeds and the supplements. So these are some products which they manufacture in the cattle feed segment, like calf starter, heifer, dairy, calf, grower. So we'll not get into the technical details, but on a broad basis you can understand is all these products are different forms of cattle feed which the company manufactures. So these are some brands which the company owns and which they manufacture products under these brands called Dhara, Otis. See, the basic focus of giving the cattle better feed or better feed supplements is to increase the lifespan of the cattle and also to increase the yield which the cattle gives, like milk and other stuff. So in the feed supplements, they manufacture supplements related to the calcium, liver tonic, etc. So the feed and supplements industry is a huge industry with a large size market to cater to, but at the same time it will be highly competitive. Talking about their manufacturing facilities, at present they have a fully functioning unit at Khanna, Punjab. They started this unit in 2013, and this is for cattle feed with a manufacturing capacity of 60 metric tons per annum. As of now, they have utilized 80% of the capacity. The second unit is at Saharanpur, Uttar Pradesh. This is for feed supplements. They started this recently in 2022, and this has a capacity of 30 lakh liters per annum. As of now, this is only 35% utilized. So overall, you can see that company has still sufficient idle capacity, and though they don't need immediate capex, but still they are going ahead with the new plans, keeping in view the next 2-3 years growth. So the company has exclusive tie-up with IFFCO Kisan. So the benefits of this tie-up are majorly that they can co-brand their products with IFFCO Kisan name. They can manufacture higher margin products which they can sell with dual branding, and they can cater to more geographies to expand their business. There were some recent developments which the company submitted to the stock exchange, that they have developed a medicine for the lumpy skin disease which is found in the cattle recently. So this is a big issue across the country, and if the company has really got a big breakthrough in this, then it could be a huge opportunity for the company. The company has also received certain orders from large companies like BMPCL, Harit Pradesh Milk Producer Company, and they've also got orders from Mother Dairy to supply their cattle feed to the various branches. So Ajooni works with a lot of popular companies or brands across India like IFFCO Kisan, Patanjali, Mother Dairy, and some other locally famous brands. And this, as an investor, brings trust in our minds, as the company has that kind of products which these kind of companies approve in terms of quality, and the company has the potential to cater to more brands like these. So after understanding some basics of the business of the company, let's understand the industry in which this company operates. The animal feed market in India is expected to grow at a CAGR of nearly 10% for the next few years. The global veterinary supplement market is expected to reach a size of about 13.76 billion by 2031. So the potential size of the market is huge. The global livestock or pet market size is expected to reach a size of about 825 million by 2027. If we try to understand the share of different livestock in India, the cattle is somewhere around 36%, buffalo is around 20%, 13% is sheep, and goat also is about 28%. So these are the major animals in the livestock space. So what can be the different growth triggers for this industry for the next few years is there can be a change from the unorganized way of breeding or taking care of cattle to the organized way. So this will shift the mindset of the farmers. They will become more systematic and they will use appropriate feed for the cattle as well as the feed supplement to boost their yields and their good health. The population in India is growing, their incomes are growing, so the food demand is increasing day by day. In terms of livestock population, India is the highest in the world. So the demand for food and supplements is huge in India. India is the largest exporter of beef, chicken and fish. So as a country or as an industry, we would like to maintain this stance. In terms of milk production also, India is the highest. And because of all these factors, lot of global companies are venturing and setting up their production facilities in India. So as an industry, you understand that there are huge tailwinds for a business which is working in this industry. Now it is up to this company whether they execute their business so well and take advantage of this tailwinds or not. What are the competitive strengths of this company is the management is experienced in this industry for the last couple of decades. They are India's first GMP certified cattle feed company. The products are of high quality and well accepted by different popular brands like Patanjali and Mother Dairy. And recently, the company became India's first company to launch their organic cattle feed. The company claims that they continuously focus on the R&D and they already have a well-established distribution and sales channel. So what is the growth outlook which the company is giving going forward? At present, the company's capacities are 60,000 metric tons per annum for feed and 30 lakh liters per year for the supplements. And now they are further expanding this to 1 lakh metric tons per annum and they are coming up with a third unit at Khanna, Punjab. And after this, the total capacity will increase to about 1,60,000 metric tons per annum. So this huge capex is coming which will increase the production capacities of the company and the company will be able to take bigger orders post this capex expansion. The company is also acquiring land parcels for further expansion of their cattle feed supplements business also. They are focusing on developing new products and they are also tying up with different milk producing companies in India. So on a broad basis, what will be the business strategy for the company going forward? They will try to improve their operational efficiencies. You will see in their financials that their margins are low. So as their operational efficiencies improve, their margins would improve. Geographically, they are centered mostly around the northern region. So as they increase their geographical presence, that will be their focus. They already have certain relationships with different vendors and customers. They will leverage that relationships and expand their business. As a brand, they already have some traction and they will try to popularize this brand in the other areas of India. The company is also open to some strategic partnerships like they have done with IFFCO Kisan in the past. Now, what are the risks in this business? There is stiff competition in this industry as there are no strong entry barriers to these products. The availability of raw material, the fluctuation in the prices of the raw material is a risk which will impact the margins of the company, and there are a lot of trade restrictions as the government closely monitors these kind of food and supplements businesses and they have to comply with a lot of regulations. Now, after understanding the business, the competitive strengths and risks of the company, let's talk about the revenue and the other financials part. The revenue was flattish in the year 2018 to 21, but they have shown a decent growth in revenue of about 74 crores in FY22. In terms of EBITDA, the EBITDA has steadily improved from about 1 crore in FY 18-19 to about 3 crores in FY 22. So this jump in numbers which has happened in FY 22, we have to closely check whether this is sustainable and the growth is further adding on to this or not. In terms of EBITDA margin, the company operates at very thin EBITDA margins, which we as investors normally don't prefer. But you see that there's a small improvement in the EBITDA margin and it has gone up to about 4% in FY22. In terms of profit after tax, the company was earning negligible profits in the last 3-4 years, but they have made a profit of 1 crore in FY22. In terms of profit after tax margin, this appears to be again further thin. EBITDA itself is just 3-4%, so profit after taxes it was less than 1% in the last 3-4 years. They have slightly improved it to about 1.4%, and We have to closely see whether this profit after tax further improves from here on or not. In terms of share capital, the share capital has increased from about 5 to 6 crores to about 10 crores now. This is because the company has been giving bonuses. They have issued a bonus of 1:9 in 2021. They have also split their shares in 2022 very recently as we make this video, and they have split it into face value 2 rupees per share from 10 rupees per share. They have done a preferential allotment of about 6 lakh shares at a premium of rupees 10. So that price comes to about 20 rupees, which is pre-split in the year 2020. So these kind of activities the company has been doing, and that is why the share capital is going up. Basically splitting their share where the share price is just about 40 rupees into face value 2 doesn't make much sense for me, as this is not very encouraging from a shareholder's point of view. Generally, the companies are expected to split their shares when they have been in the market for 10-20 years. They have been successfully running their business, and the share price have moved up to such an extent where the people are hesitant to trade in such shares because of their large ticket size. The reserves are more or less flattish as the company is not adding much profits to their bottom line. The borrowings are under control. They have debt equity of about 0.37 and they have about 5 crores of debt on the balance sheet. The trade payables are growing, but they are in line with the growth in the revenue. In terms of fixed assets, as the company is regularly doing capex in the last couple of years, they have gone up to about 6 crores. Inventory wise, the company has about 5 to 6 crores of inventory on the balance sheet, and the inventory days are also not high, so the working capital management is fine. In terms of trade receivables, they have about 14 crores of trade receivables on the balance sheet, and the trade receivable days are somewhere around 2 to 3 months. There's an improvement in the trade receivable days. They have gone down from 115 to 68, which is a good sign of working capital management. In terms of cash equivalent, they don't have much cash on the balance sheet. In terms of cash flow, operating cash flow has been negative last 3 years from FY18 to 20, but they have turned it positive in FY21 and further improved to about 3.6 crores in FY22. We have to closely watch the cash flows also of the company, and the company should not be stuck in a bad working capital shape. In terms of free cash flow, the company is not able to generate much of free cash flow, as the bottom line profit is also not very attractive. So they have just generated about 1.5 crores in FY22. One reason for lower free cash flow is also that the company has been regularly doing capex in the last few years. In terms of ROCE, this doesn't look so attractive, as we generally look for 15% plus ROCE in any business. So it is just at 9%, which is also a development in FY22. In terms of shareholding, there are no institutional investors in the company. The promoters hold about 52% stake and the public holds about 47% stake. And as you know, recently the company has done a stock split from face value 10 to 2. In terms of valuation, the market cap is somewhere around 40 crore, revenue is about 70 crore. So market cap to sales wise, the company's valuations look very attractive, but you have to also look at the fundamentals of the company. The margins of the business are very thin. The EBITDA is just about 4% and net profit is just about 1%. ROC is just about 9% in spite of improvement in FY22, and the PE ratio, that's why, because of the lower margins, is somewhere around 38. And in terms of book value, it's trading almost at a 2.5 times valuation. So looking at the fundamentals of the company, the valuations are not so attractive. The valuations at these levels become attractive if the company's margins improve, if the company's return ratios improve, and the company is able to sustain a growth of at least 10 to 15% for the next 3 to 5 years. So the most important thing as per me in this company is you have to closely see how the promoters are executing. They are whether their business ratios like the profitability, the return ratios, the sales growth is improving, and are they able to maintain consistently these numbers. Because the company is not new in the market, they have been in the market for 3-4 years and they have been in the business for the last couple of decades. So what they have not done in the last few years, whether they will be able to do going further or not, because the industry is very competitive and there will be a challenge for them to grow and further improve their margins together. The statutories of the company are Harjeet Parvesh and Company. The ROE is just about 6%. The company is not paying dividends. The director's remuneration is about 38 lakhs. And a few other things you should note about the companies. Recently, their CFO has resigned in FY22. One of the directors, which is Mr. Partek Singh, has got a 66% increase in remuneration when compared to previous year. So there are some companies which are unlisted into the same or a similar business which the promoters are common directors with. So there are some intercompany transactions which are being done by this company, the purchase and sale transactions, which will be a part of the revenue done by this company. They have somewhere around close to 6 crores of debtors which are more than 1 year old. So you have to closely see whether the company is able to really collect the money from these people or not, and the sales which the company is doing is actually a real sale or not. The company has done violations in compliances of several acts like the Gratuity Act, Labour Act and the SEBI regulations sometimes. So these are the things you should also keep in mind before you invest in the company. So this is about Ajooni Biotech. To summarize, let's discuss the thesis and antithesis points. Location wise, the North Indian Punjab region is a hub for these kind of industries. So the company is located in a very good strategic location. The promoters have very good knowledge about the business as they have been into this for the last 20 years or so. In terms of market size, the business has huge potential. It depends on the company on how well they execute. And in terms of valuations, the valuations look attractive, but this attractiveness is on the condition that the growth of the company improves, the return ratios improve, the margins improve, and that improved ratios sustain regularly in the future. In terms of antithesis points, this is a very competitive industry, so there are no strong entry barriers to these kind of products, and since there are no strong entry barriers, there is no strong competitive edge in this company. In terms of fundamentals, the quality of fundamentals we generally look at, those kind of that kind of quality is lacking, but at the same time in microcaps you can't expect them to be very good. There is a risk of execution, as whatever the capex the management is doing, whether they will be able to fulfill and use that at full capacity or not, whatever products they are launching, whether they will be able to sell them or not, whether the margins will improve or not. So execution risk is going to be a key risk in this business. In terms of corporate governance, I don't see everything so clean in the company. There have been small lapses here and there, so you have to closely see whether those kind of things do not continue in the future. So this is about Ajooni Biotech. I hope you like the unbiased analysis and you are able to take a wise decision of investing in the company. So if you like the video, hit the like button and subscribe to the channel, and don't forget to join our Telegram channel where we can be in touch on a daily basis. Thank you for watching, and if you want me to make videos on your favorite companies, whether they may be a small and micro cap company also, do comment the name of the company below. I will surely consider for my upcoming videos. Thank you for watching and have a wonderful day.